Now, joining me right now in the studio is Geoff Lewis, the head of investment services at JPMorgan Asset Management, which manages more than $1.3 trillion across the world. That's a lot of money, obviously, and Greece could do with a bit of that right now. Other countries could as well, including the States. Geoff, I mean, before today, you said that, in fact, there's a 60% chance that the US will not go into recession in the next 6 months. Mark Mobius just just now told us that he does not see a double dip. This sell-off this morning, again, all that money that clearly the bank manages, your head of investment services, what's your initial reaction so far this morning? And it's before the jobs report.
Well, I think my initial reaction would be everybody was focused on Washington and the theatricals there for the last couple of weeks. At the same time, the economic data was going south. Now investors have realized that the Washington blockage is out of the way, but the economic data is looking worse, and we're not going to get such strong growth in the second half. I think that's quite clear, with consumption flat going into the third quarter. So it's that realization, I think. Markets are off. The S&P is down 12.5%, so we're now in correction territory. Euro Stoxx 20% from the peak. I think a lot of us were surprised we hadn't seen this correction earlier, given all the shocks and all the negatives and headwinds that we've seen this year. So it's been long overdue, I think.
Mark Farber, again, told us about an hour ago that, in fact, he sees it getting worse. It's panic selling. And then just had Nick just now on the equity sales floor at MF Global saying that, in fact, it's going to be pretty brutal on Monday if that jobs report is not stronger than the economists are forecasting.
I think that is the case. We've seen that investor sentiment is very, very fragile. We've seen strong evidence of contagion amongst the European bond market spreading over to all risk assets. Correlations have converged on unity, as they do in this kind of sell-off. All our valuation models are telling us actually there is good value in equities, provided one does not have another recession.
So a silver lining in that. I mean, what are your clients also telling you? Is it simply a flight to safety, Geoff?
I think it is very much a flight to safety. In these volatile circumstances with all these headwinds and shocks, then cash becomes attractive even if it's not earning anything. And we've seen that from negative TIPS yields. People are willing to pay just to preserve capital.
And some of the bonds are actually below the cash, aren't they?
That's right, yes. So I would say, unless you really do believe we're going into another recession, I think it's not a normal recovery. It was a very unusual global financial crisis. We've pulled out of that, but now fiscal and monetary stimulus has peaked and is fading away quite rapidly. We think the most likely scenario is sluggish growth and low inflation. That's not necessarily bad for equities historically.
The inflation is picking up, isn't it? Food inflation is quite high, and of course the sluggish growth, we've got quantitative easing 3 being talked about now. That's a concern. We're already in quantitative easing 2.5 more or less, and it hasn't really worked, has it? That's going to be inflationary for Asia.
Quantitative easing didn't work in the sense of actually stimulating the US real economy. I think where it did work was averting a fall into deflationary expectations. Expected inflation came back quite nicely to around the 2–2.5%, and I think that's what the Fed really sought. More of the same. I think people will be pretty sceptical, and I think the bar is still quite high. I don't think the Fed is on the point of QE3 myself.
How do you position yourself then between now and December?
Well, these are very volatile markets, but as I say, most of our valuation metrics suggest that valuation is returning now to equities. Bonds are looking very overpriced, but they've been the right place to be until recently. So if I was an investor that had been very risk averse, I would now, I think, be putting some money on the table and averaging back into the markets at these levels.
There you go, take a bit of risk on the table. Geoff Lewis, thanks for coming in, head of investment services. Have a very good weekend at JPMorgan Asset Management. Now, plenty